Hi, everybody. Welcome to session 3.4. And in this, we'll be talking about financial statements, financial controls within a nonprofit, and audits, specifically like audits of like financial statements. The goals for this class session are to have you understand balance sheets, income statements, and cash flow statements, to be able to describe the obligations of restricted funds and then how to be released from them, to be able to explain best practices for financial controls in a nonprofit organization, and then describe the steps of a proper audit for a nonprofit. So let's start with financial statements. Some of you may have had experience with accounting statements. Some of you may have never experienced them before. I'm going to give you a quick overview of what these are in the recording, and then in class we're going to pull up some specific financial statements of an existing nonprofit and show you how they work. But here's just a slide to summarize what each of these financial statements are meant to show. And it's important to understand that each of these has a job to show something that the other ones can't. The money that comes in and out of an organization, the financial assets that it holds, they all have different ways of perceiving them. And no one financial statement captures every sort of angle you'd want to take on the money of a nonprofit. And so the purpose of having different financial statements is that each one is like a different lens for viewing the financials of the organization from a different angle. And so that's why these financial statements each matter, is because each one sort of gives you a new and different perspective on the financials that the other ones cannot. So let's talk about each of these in turn. So let's start with the balance sheet. The balance sheet is a snapshot of the overall financial health of an organization. And what it's going to show you is, on one side, it's going to show you all of the assets of the organization. So everything with financial value will be on one part of the statement. And then liabilities are going to be like debt obligations. Any money you owe to somebody else is going to be shown there. And so you'll have assets and liabilities in this balance statement. Now, unless you have an exact amount of debt that's equal to everything that you own, then that's not going to be in balance. And we're going to show you in class how you get a balance with a balance sheet by having assets on one side, and on the other side you have liabilities plus, for nonprofits, is called net assets. And we'll sort of show you how that works on a balance sheet. But like I said, the balance sheet gives you an overall picture of how a nonprofit's finances look. And so you can take a snapshot at any moment, and balance sheets are always dated from the date when the figures were collected and put into the balance sheet. So you can see on a particular date, this is what the overall financial well-being of the nonprofit looked like. Income statements are different because they usually capture, rather than a snapshot, a time period, typically like a year, and they show you all the money that came in and all the money that went out. So this will be like kind of like looking at your bank statement for a month, right? Where you see all the money that came into your bank account that month, and then all the money that went out of your bank account that month. Income statements, like I said, are usually calculated over a year's time, but you can do them in shorter time periods or longer ones too. But it's going to be all the revenue, the money you brought in, all the expenses, all the money that went out, usually covering a year time period. And so this is how you could calculate whether a nonprofit is operating in the black, meaning they're making a profit, or if they're operating in the red, where they're losing money. And the income statement is what's going to show that to you. The third one we should talk about is a cash flow statement. Cash flow is about cash coming in and out, not just money. And I know that sounds strange because what is money except for cash? Well, it has to do with the accounting system that most large organizations use, which is called the accrual method of accounting, which is that when somebody makes a legally binding promise to pay you, you count that as income. And then when you make a legally binding promise to pay somebody else, you count that as an expense. And the reason you do that is because if you're not calculating promises made, then you're not really capturing the full financial health of an organization. You're not capturing like how much they really are bringing in or sending out. And so an income statement shows you those accrual methods, right, where you're also doing the math on promises made. Whereas a cash flow statement doesn't show that. It just shows cash coming in and out. So it may be the case that somebody promised to pay you $1 million, for example, but they haven't actually paid. And then you owe your employees $300,000 in payroll, in payments for payroll. Well, the problem is, you could, if on the income statement it looks like you're profitable, but in the cash flow statement, if you don't have the cash for the $300,000 in payroll, then you're going to be in trouble. And so that's why a cash flow statement is used. If you use, instead of accrual accounting, you just use cash-based accounting, then the cash flow statement and the income statement will basically be the same thing. Again, if this is sort of like high level and conceptual, but we're going to show it in practice in class with some actual financial statements. And then finally, the fourth one, which wasn't on the intro slide or the goal slide, but it's something that we'll get familiar with, is what's called the statement of functional expenses. And this is just an expense statement for a nonprofit, meaning it just shows how they spent their money, not how they made it. And it's categorized according to program costs, administrative costs, and fundraising costs. This is based on page 10 of the Form 990. We'll take a look at that together so you can see how it works. But accounting firms will also create a statement of functional expenses when they put it in the audited financial statements. And we will see all of this because we'll look at somebody's actual audited financial statements together in class. Okay, that last one, by the first three, balance sheet, income statement, cash flow statement, you'll see those for large for-profit corporations just as much as, for any for-profit corporation, just as much as you see them for nonprofits. That statement of functional expenses is something that's unique just to nonprofit organizations. Sometimes nonprofits take donations where they make a promise to use the donation in a particular way. Like, for example, they might say to the donor, hey, we promise that we'll use your donation in Utah County. And if you make that promise, then you're limited by law, by the promise, by a contract, and the way you use that money. And good accounting practices mean that you account for your restricted funds specially. The problem is that sometimes a restriction is a bad thing instead of a good thing because circumstances have changed, or new problems have arisen, or sort of other unexpected outcomes are at play, and the restriction is now a burden instead of a blessing to what the nonprofit's trying to accomplish. In those circumstances, there are ways that you can get out of a restriction. And those are the following. First of all, you can just ask the donor to release you. You can go to the donor and say, hey, you gave us this donation with asking us to promise we'd use it in Utah County. Our services aren't needed in Utah County anymore. And you might ask, can we do this in Salt Lake County instead? Very reasonable request. And the donor might say, yeah, that's fine. And so the donor basically is releasing you from the restriction. Sometimes, though, donors don't want to release you, or sometimes donors are not even alive anymore, and so you can't ask them. And so the law in pretty much every state allows for you to get out of a restriction from a donor if you do the following things. Either you get a court to agree that the restriction is unlawful, impractical, impossible, or wasteful, and the attorney general has a chance to challenge it. So basically, you'd bring a claim to court and you'd say, hey, judge, this restriction we're dealing with is unlawful, it's impractical, it's impossible, or it's wasteful. And then you would have to notify the attorney general that you're making this claim. Then the attorney general has a chance to challenge that if they think that you should still be stuck with the original restriction. So that's one way, and probably the more common way that restrictions are released for large donations anyway. But you don't always have to go to a judge. You can go directly to the attorney general in the following cases. If the donation with the restriction was less than $25,000, was made more than 20 years ago, and your new purpose, the new use that you have in mind, still fits the donor's charitable purpose. Now you can see how number 2 and 3 will be more common if the donor is no longer alive. And these are available to nonprofits if they find that restricted funds have become a burden instead of a blessing. Okay, but you could also imagine scenarios where you want to change a restriction and none of these 3 ways work for you. And you can't succeed with any of these 3 ways. And if that's the case, you're out of luck. All right, let's talk next about financial controls and how nonprofits pay attention to making sure that their money is spent properly. There are certain things that you really just should do in the way you manage your nonprofit. And I think nonprofits make mistakes here because it's their instinct to just be trusting of others. If you're all there to do a charitable purpose, like your employees, your volunteers, and others, you sort of automatically want to trust them. This is actually something called benevolence-based trust. But the problem is people can have very benevolent intents and still do deeply unethical things. And so it's good to follow some standard best practices to make sure your finances are being properly controlled. Make sure that any payment methods have limited access. Only the right people can access the right way to pay for things. And so it's not the case that like everybody can grab the nonprofit's credit card if they want to spend money. If there are large purchases being made, you should require extra oversight. There should be additional leadership approval of large purchases. And you can even put it into like the way a credit card operates, where it cannot process payments above a certain amount. Banks can also be asked to not approve payments above a certain threshold without, two people approving it. And so you can get control over how large purchases are made. It's important to segregate financial duties so that no one person has total control over all financial matters. And so you might have, you might have some people who have the power to, process payroll, and other people have the power to, to generate financial reports. Like there's a range of ways that you could segregate duties that would protect this abuse by one person who has all the power. And then finally, make sure that your board has an active finance committee. And so this is a committee whose responsibility is to review financial statements, answer questions for the executive director or leadership if they have questions about financial issues. And you should have on your finance committee people who have a background in financial expertise of some kind. A CPA, for example, would be a great person to have on your finance committee. All right, let's talk next about the financial audit process. Most large nonprofits should be doing an audit every year. I sit on the board for University Impact, and I just met with our auditors last week at the time I was recording this. And so let me kind of talk through how audits typically work. You should have at least one board member who's a financial expert. We mentioned that in the previous topic. And you should have been operating in a way that's amenable to the audit process. And what I mean is you're keeping good financial records, because that's what they're going to do. Is an auditor is going to come in and say, hey, we've reviewed their records, we've reviewed their processes, and we can tell you that what they're telling the world about their finances is probably true. And you should also have an audit committee of the board, a group whose job is to oversee the audit process. And like I said, you do this annually. The way it goes is the board initiates the audit process, and then an auditor is solicited, evaluated, and selected. So you pick an audit firm. The auditor reviews the financial records and methods, accounting methods of the organization. The auditor then issues an opinion, is what it's called, and then also a set of financial statements that they're claiming to be accurate or not. And then the board reviews and approves the audit, is how this process works. So let's talk about each of these steps. It is a board level function to make sure that an audit is initiated. And you can delegate it to the audit committee. It doesn't have to be the entire board, but it should be the board overseeing the audit process. And it is the board that's ultimately responsible for the accuracy of the audit. When you're trying to pick a good audit firm, the main characteristics you want are obviously competence. They should be good at this. They should also be independent, meaning you shouldn't be using a firm that's providing other services to you. You should be using a firm that only does audit work for you. And they should be prompt. Sometimes audit firms can be really slow in their work. And the problem is there are some regulatory requirements that expect you to file audited financial statements. And if your auditor is not timely, you're going to miss filing deadlines. And so it's important to make sure that they have these attributes. For these middle two steps, where the auditor reviews your financial records and then issues financial statements, this process is a lot more successful if you've been using good accounting procedures from the beginning. If your accounting process is a mess, it's going to be much harder for the auditor to evaluate what they need to evaluate. And in nonprofits, there's a lot that can be accounted for incorrectly. For example, a fundraising dinner's revenue has to be allocated properly between a fee for service and public support, because you're selling banquet table seats and meals, but you're also, soliciting donations, and you have to make sure that you've accounted for these things well. We're going to talk about the kind of opinion that an auditor issues. It's called an unqualified opinion, which is a funny sounding name. But we'll talk about what that means in class, because it basically means they don't have any qualifications or hesitations about the financial statements. And then the audit committee reviews the audit and with the auditor and the relevant staff. Usually auditors are going to point to things that should be improved or changed. Those things should then be brought to the entire board, and then the board approves the audit. And so it's important that the board is ultimately responsible for the accuracy of this process. Pretty much everything can be audited within a nonprofit, not just the finances, and in fact probably should be. And so here's some examples of other things that can be audited. You can audit the effectiveness of operations, like are you actually doing things the way you want to, and are they actually having an impact? You can, if you're a large organization that has a whistleblower process, you should be auditing those whistleblower reports and making sure that every whistleblower report was properly dealt with. Your impact assessment procedures, the ways you're measuring your impact, you could audit those and make sure that your measurements are accurate, and that the people you're hiring to do your measurements are doing a good job. And you should have a conflicts of interest policy and do a regular review or audit of that process. In all cases, an audit procedure similar to the one I described should be created and followed. And these are a lot of things that the board would oversee. Now, you don't have to do all of these audits necessarily on an annual basis, but this is what you would call, all of these are what you would call performance auditing, where it's auditing not the finances, but the performance of an organization. Some questions we'll discuss: why are audits so hard and complicated, and what do you do if you encounter a major problem in an audit? And that's that. So I'll see you all in class.